On the Money with Anil Vazirani begins now. Retire and stay retired. Safe, smart, and secure. Now, here's host Anil Vazirani.
And a good afternoon. It is I, Ken Morgan, along with Anil Vazirani, and Jon Armstrong is here as well. Gentlemen, good afternoon.
Yes, good afternoon, Ken.
How are you, Ken?
I am doing well. And here we are with another great show starting up today. Anil Vazirani, of course, I hope all of you know who he is. He has achieved the status of a qualified financial advisor. He has a Series 65 license, which means that he knows everything you need to know to be a financial advisor, all the laws and rules and all that kind of stuff.
Man, you're kind to me, Ken.
Well, it's true, absolutely true.
As long as you're saying it and not me, that's okay.
Today we're going to talk about one of the ironically strangest, most difficult things that people have to do when they plan for retirement. They have all this wealth built up, and then what do you do with it? How do you take it out? How do you use it?
Sure. So what we got, Ken?
Well, we're going to talk today about the safe withdrawal rates. We're going to talk about sequence of returns risk. We've talked about that before, but maybe a little confusing there. And we're going to talk about the different buckets in which you are planning for your retirement. What is the difference between using qualified and non-qualified money? And then maximizing gains or minimizing your loss. Which is more important to you? And these are the kind of things that you can figure out with Anil.
So you know what, Ken? Let's just take it right from the top, which is one of the questions that we pose. Safe withdrawal rates, defining and explaining sequence of returns risk. What can be done to try and reduce these risks? I was joking with John, and I was telling John, if you really think about a safe withdrawal rate, it's kind of an anomaly purely from the standpoint that if you have stock market investments which fluctuate on a day-to-day basis and there are risks and potentially high fees, the term safe withdrawal rate seems to be kind of an anomaly.
Yeah, it needs to be put in quotes in there.
Because how can you have a safe withdrawal rate from an unsafe or a risky investment?
That's a good point, yeah.
But then I'll turn over to John now.
Well, one of the articles I've referenced in the past was from the Journal of Financial Planning. It's a few years old, and it was talking about the safe, quote-unquote, withdrawal rates with stock market portfolios. And it said people that take the 4% rule, or 4% of their investment, it has about an 18% chance of failure. For today's show, I wanted to try to find something that was a little bit more relevant, and I found an article from Financial Advisor magazine from September 1st, 2015, by Wade Dokken and Wade Pfau. And in that article, I'm just going to summarize it pretty quick. It talks about just the concerns of more relative to 2015. It says, new research shows that Americans retiring in 2015 need to be far more conservative in their withdrawal rates during retirement. The historic 4% annual withdrawal rate is over 2 times the level that Americans can safely withdraw without expecting to outlive their assets. The real safe withdrawal rate, and this is of course according to their research, which accounts for fees and then the stock market performance of today with the bond market levels, is actually under 2%, Anil. Think about that. They're saying the safe withdrawal rate is 2%. So someone with $1 million portfolio, if they were to retire, can expect to take $20,000 from that portfolio in order to have it last.
And you know what, John? We're going to show that is kind of flawed provided, if you use the right investment vehicles, that may not apply to it, but I'll let you finish that article, and then we'll come up with some solutions.
Correct, yeah. And this is, of course, only saying if you have 100% of your money at risk. This isn't saying this is the end-all, be-all, this is the only option out there. What this is saying is to account for today's volatility, all the topics that you cover, Anil, in your workshops and on the radio, about just the safety of trying to be in the stock market today, if that's going to be your primary spot for taking money, it's saying that you need to be cautious of that and to reduce the amount that you're taking.
And let's also dispel another myth. The article says, provided that your investments are in stock market type fluctuating risky investments, a safe withdrawal rate, which used to be 4%, has now gone down to maybe 3 or 2%. But, a lot of these folks are not bringing out the true dangers of the high-risk, high-fee variable annuities. Especially the one with Jackson National that grows at a simple interest return on the income account value or living benefits. It's a simple interest roll-up, not even a compound. And what they've done to these high-risk, high-fee variable annuities is that these insurance companies have got these fees so high, between 3 to 4% on an average annually, not only giving the consumer only simple interest for lifetime income, but they've also reduced the lifetime income payout percentages, John. So it's just not stock market investments like stocks, mutual funds, or stock funds. We really need to educate the consumer on the pitfalls of the high-risk, high-fee variable annuities as well that tie into this article.
Absolutely, and also just to pick up on that, Anil, is when people are taking their payments from the high-fee, high-risk variable annuity, they need to know if that's a single payment or a joint payment. In most cases, we found it's single payments on that type of an account.
Yeah, we're going to continue this discussion after the break. You're listening to Trump Vazirani. I'm just kidding. Where is Ted Cruz? Where is Marco Rubio today?
They were afraid to come in.
Well, I see the doctors in the house.
Here's a phone number that you should not be afraid to call, 800-957-5604, extension 200, and set up your complimentary Knowledge is Power.